All right, let's turn to an economist. Bloomberg ranks among the most accurate for his economic forecast. He is John Herrmann. He is the senior fixed income strategist at State Street Global Markets. He joins us now from our Boston bureau. John, good to have you back with us.
Same here, Carol.
We've had some time to digest this number. A bit of an eye-popping when you kind of break it down. The Treasury market, though, reads it that, things are getting better when it comes to the labor picture. Do you agree with the assessment there?
Yeah, we were basically for the last several weeks, we've been looking for Treasury yields to back up. We've been seeing signs of the economy strengthening. We're seeing better spending signs, whether it's households or businesses. And the pace of job growth, believe it or not, appears to be more constructive than what this report suggests. So we were all, there were many moving parts to this report, and when it came out and it broke on the tape today, there was a lot of scurrying to really get to what's going on here. But it's pretty safe to assume that about 100,000 jobs off of payrolls were impacted by the weather. So we think, we may not recover all that 100,000 next month in February. It may take a month or two because the weather's still a little bit on the rough side. It may take another month or two, but, it's safe to assume that the number, for example, on the private payrolls coming in at close to 50 with another 100, that's about 150. That was very close to market consensus. So basically, our take is, this was an okay report, not a great report, okay report, in line, and then we're ready to go ahead.
But John, you mentioned constructive, that there are parts that are constructive. What specifically tells us that in your view?
Well, let's take a look at a couple of things. First thing is we had a very solid gain in manufacturing jobs. That all fits with the ISM index and ISM reports. First thing, we had a very decent gain in wages. Also, it appears that weather by itself was the responsibility for cutting into the work week and hours worked. So we think, though, there's hopeful signs there. On the household side of the survey, things get very, very interesting with this unemployment rate plunging 0.4 to 9%. So there's some very interesting things there. And, it may take a few minutes to go into it, but, what we're seeing is the participation rate of older folks, so to speak, people over 50, as participating more aggressively, and they were the ones responsible for driving the unemployment rate down, whereas the young folks, the teenagers to late 20s, their participation rate is very, very meager, and their unemployment rate is actually rising.
How concerning is that, John? I mean, as an economist, how concerning is it when people start to just drop completely out of the labor market and don't even bother?
That's very much not a good sign, and we don't like to see young people, abstaining from work. But what we're seeing is we're seeing them opt not to participate. That's the amazing thing. They're choosing. So, and that development had been going on for a few years prior to the recession. And so what it suggests is that there might have been some wealth effect, believe it or not, with the parents, wealthy parents, and teenagers not engaging in work. So that we're a little bit troubled by that. We're not really pleased by that. We'd like to see the young people acquiring skills, really building up their work resume, and there's the strongest relationship between lifetime income is with a strong early start to the job career.
Do you think, John, we're talking a lot about what we can expect next month if there's no more bad weather, maybe a big bounce back in the number, but going forward after the weather-skewed numbers are all done, can we start expecting to add serious amounts of jobs? I mean, can we expect to go back to the times when we were adding 300, 400,000 jobs a month anytime in the near future?
You actually, when we look back over the last 10 years, there are only a few months where we actually gained, had job gains of that magnitude. We have to go back a couple of decades to get that kind of those kinds of gains. And I think that's what Chairman Bernanke's hinting at when he says it's going to take a while to get this unemployment rate back to a level that we're really comfortable with. But, big picture-wise, again, there was about 100,000 jobs impacted by the weather. We should claw back some of them this coming month and more in March. And then we think that we just get into more of a steady pace of job growth. And some of the keys are going to be, situations where the small businesses become more aggressive, they take on more risk, and the environment's getting better for small businesses. So we should start seeing, decent gains above 150,000 in the, middle, second half of this year.
John, just a few seconds left here. I want to go back, though, to that unemployment rate. While the bond market sees it as maybe a good sign potentially for the labor market going forward, that was a big difference from the prior month. I mean, doesn't a little bit of that kind of worry you about what it could mean in terms of people just saying, I've had enough, I'm out of the labor force? Just quickly.
Again, so, where you might expect to see that historically is in the older workers, but yet they are working even more aggressively and their labor force is rising and they're working great. So it's really just a matter of really motivating the young people. All
right, and that's actually something we're going to talk about a little bit more later on. There's a Bloomberg Business Week story on it, so we'll get into that. Hey, John, thank you as always. Have a great weekend. John Herrmann of State Street Global Markets.